Want to give a little background for those of you that recall, or maybe not. My background started off in real estate finance. That's how I met Jim West and a lot of folks in this room. And about 3.5 years ago, we sold our company called Johnson Capital, and I wanted to be able to be cycle agnostic, meaning I wanted to be able to be an investor throughout a cycle, not to a cycle. And in the downturn, if you were a single-family home builder and the home building business went away, you were out of business. And I always believe good market, bad market, there are opportunities. You just have to really try hard to find them and not be a lemming who follows everybody else off the cliff, but be a front runner. So one of the things you're going to hear about today is how we've done that. It's been 3.5 years in the making where Forum is now, a direct real estate plus an asset management company that invests throughout a cycle, not to a cycle. And for those of you that have heard me say we invest up and down the entire capital stack, I don't think my mom understands what the capital stack, she just believes in me. So I'm gonna give a quick overview. Okay, so, and you'll see some slides. The equity part of the capital stack, obviously, that's the money that we put into these deals, and we typically put a loan, and it starts, from the senior most part of the loan, the 0% of the loan, all the way up to, let's say, a 70%, which is the junior most part of the loan. So when we refer to capital stack, that's what we're referring to. So if there's one thing that you guys take away from today, if you're sitting in bed tonight going, wow, I learned there was too much information, just go back to why. I always tell people, just understand why we're doing what we're doing, not what we're doing. We're doing real estate, we're buying apartments, we're building apartments, we're making loans, we're buying loans. But why we're doing it is the most important part. Why are we investing in what we're investing in and when we're investing in it? So with that, the why. I'll turn it over to our moderator, Shelby Noble, and she'll introduce the folks up here on the panel.
All right, thanks, Darren. So this will be similar to what we did in 2017 at the Halcyon Hotel. We had really good reception from that. So if you have questions, we have 3 people with mics throughout. So please, we like this to be interactive. So on stage today, we have Darren, founder and CEO. We have Chris Furman, who's managing partner of Forum Capital Advisors. Jason Brooks is with Janice Henderson Investors, which is our sub-advisor for Forum Capital Advisors. We have Kevin Foltz, who is Managing Director of Development, Rich Wilson, VP of Development, and Andrew Davis, who's VP of Investment Management. And I run our capital markets. So with that, I think it's important to start, kind of based on what Dar was saying, talking through these data metrics and really thinking what Forum is doing to move forward from what happened in, the early coming out of the recession, now how we think about data in the markets that we're looking at. Rich, if you can go into that.
Yeah, I'd be happy to. So in the last year, we've undertaken an exercise to try to look, take an analytical approach to looking market to market at a number of different metrics to try to target where we think the best opportunity is for the long term. And by that, I think we mean in terms of long-term value creation, we want strong ongoing rent growth and fundamentals and characteristics of that market that is going to consistently provide that, even if there is changes in the cycle within the coming years. Rent growth, value creation, and NOI growth. So I would say we started with looking at specifically what I would call the traditional metrics, those being population growth and net migration into a metro. Secondly, job growth into a metro. And then rent, some of the multifamily fundamentals, rent growth dynamics as well as occupancy dynamics. And we looked both historic and projected to understand where has a metro been and where are others projecting it in the future. But I think beyond that, and Darren got to this point earlier, is Forum is very interested in why. So if somebody else projects forward rent growth, why is that happening? What are the characteristics of that market that would allow us to believe in that market in the longer term? So we started to seek out other metrics and indices that might indicate different aspects or characteristics of that location that would continue to draw people and create ongoing demand. So some of those things included, and I'll just give you sort of broad categories. There's a lot of granularity behind it, but But some of those things included looking at the political dynamic. And by that I mean in a couple ways, looking at tax policy at a state level and whether or not it is business friendly and attracting jobs, and whether it may have a propensity to continue to do that. On the other side, how reliant is the state on property taxes, which could be dilutive to NOI in the long run, and how meaningful is that relative to the growth dynamic that's happening. Additionally, supply constraints. How hard is it to build into that market is another topic that we took a look at. Secondarily, from an underlying economic standpoint in each of these metros, how innovative is that underlying economy? So there's indexes you can look at about the type of economy it is and whether or not it supplies some of the characteristics that Dar had spoken about of what creates innovation within a metro area. You know, if you look at Seattle 20 years ago, Amazon didn't exist. So if you can build some of those homegrown businesses that become the superstars, what is the characteristics of a metro that can help to propel that forward? And we want to be there. I would say other things we're looking at is general quality of life. I think you heard earlier that there is a lot of discretionary migration, especially with the millennial groups. They want to move to a place because it's a place that has sort of a live, work, play environment and or recreational aspects and a quality of life climate that they're drawn to. So we looked at quality of life. There's the affordability metric and the trends towards affordability. And also, I think generally supply and demand. And I think that we looked again in the way that Dar spoke about in terms of long-term household formation, call it 10-year household formation versus supply, but also what's happening in the near term. And what we did is a ranking system among various of these indices and metrics to try to understand where the different metros lined up next to one another.
And based on those metros or metrics, what do you see as growth markets for Forum today?
Sure. So I would put it into two categories. There are certain markets where we're already active that I think we see underlying characteristics and fundamentals that we would continue to want to work in. And the reason I categorize this in this way is that we have existing relationships with folks that are in that market, whether it be the brokerage community and or on the development side, consultants and others within that market that can help to feed further investment opportunities. So those types of markets include Denver, obviously, which we're the most connected to by virtue of it being home. There's Phoenix, which we're already in, Tempe in a development project. Minneapolis is a metro that we're actively invested in and have been for some time. Atlanta, Charlotte, Raleigh, we have sort of tertiary market investments around those major metros, and we think those major metros have legs for the future. The second category is where are we currently not active, but we think that there's long-term fundamentals that would support engaging in relationship building. Those would include Salt Lake City, which we're actively pursuing, Austin, Dallas-Fort Worth, Orlando, Columbus. So there are different sort of categories of where are we versus where do we see expansion opportunity.
I think, Rich, one of the things you bring up, and for everybody here, if you read the paper, watch the news, you hear these same cities over and over. And it's no shock that you're seeing some of the things, whether we slice it and dice it 100 ways. As Rich said, it's lifestyle. You think about Florida. Well, why is Florida? Why are we seeing 6 to 8% rent growth per year in Tampa? Well, you've got New York, which has state, federal, and city tax now. So they're being taxed at 55%, plus the cost of living is so astronomical. People are saying, hey, we'll spend time in Florida. We'll go to Texas. So it's no surprise probably to the crowd when you see the same cities over and over or read or hear about them.
Thanks. And Andrew, what is the, I mean, these are different markets than where we have been investing over the past 5 to 10 years that were more tertiary, secondary. How do you see deals today? What types of submarkets are you looking in these specific growth markets?
Sure. I think Dar said it best. There's a lot of deals out there. It's very difficult to find deals that pencil. So I would start that it seems today that it's a very fully priced market in a lot of the deals that we're looking at. And so to Darren's point on the lemming analogy, we're not out there waiting for the broker offering memorandums to come in, give it an underwrite, and go do the deal. So I'd say that we're patient right now on the sidelines looking for opportunities, but they are very difficult. 4 or 5 years ago, when there was a basis play to be had in a Montgomery or a Jackson, that made a lot of sense. Today, those basis plays are done. So if we were to see a market correction of any, to at any point in the next few years, maybe there's an opportunity to go back and do something like that again. But the basis plays aren't there, and so where we're seeing a lot of activity is on the value add side. And value add right now, from our standpoint, is on a risk-adjusted basis very difficult. So folks are underwriting 70-75% LTV. You're talking maybe putting $10,000 a door into a K&B program, kitchen and bath, maybe getting $250 to $300 a month in rent premiums. There's a lot of execution risk with that, and obviously those value add players are competing against new supply in all of these markets as well. So I would say that, again, we're patiently waiting on the sidelines. Not on the sidelines. We're patiently in the game, but we're not seeing a ton of deals that come our way. But I think to Rich's point on the relationships, whether or not they're with development partners, other equity partners in markets that we're interested in, we need to be hanging around these markets. We need to get to know those people. We need to maintain those relationships, because when the tides do change, that's when we're gonna be able to make a deal happen.
Maybe touch a little also on buyers that we're seeing for our properties. So Inverness Cliffs is a good example of the buyer capital coming into those markets.
Yeah. You're stealing our presentation later. It's okay.
High level.
No, high level. So yeah, I mean, that's a good example of where we've got a buyer for a property that we own in Birmingham, Inverness Cliffs, 414 units. And the buyer that's coming in there is very aggressive on the value add. I think they're underwriting, penciling up to $15,000 to $20,000 a door. This is a 1980s product. Again, a great deal for us, but for what we saw was not the opportunity to go in and do that. And so I guess to your question is that there is a lot of capital chasing these type of deals. And so, where we on the disposition side, we're obviously cognizant of that as well, and that the fact that there is so much capital, yields have compressed, where and what are the right markets to get out of, because, and Inverness Cliffs is a great example where when this deal trades and we're expected to close in August, it would be the highest price point per door in Birmingham.
Ever, yeah. One thing Shelby asked about, who are the buyers? Forum, I like to say, is a strategic investor, not a capital allocator. And most of these buyers are funds, and we see buyers from all over the world now. The Koreans who are actually a partner, and some we're doing, a 4% return is a great return, just anything but Korea for them. They got so much money sitting there. So they've got 5 to 7 years to get in and out and try and create value, or they don't make any money, and they have to keep the lights on. So it's hard to compete with people that are capital allocators versus investors.
Shifting a little from acquisitions on the development side and the types of returns and what we're seeing today.
Yeah, I think, to Andrew's point, I think we're now more aligned from an acquisitions and development perspective than we ever have been, both in markets and product type. We've been buying in the kind of renter by necessity, what we called our Essential Collection or Premier collection for years, really since our inception, and now we're seeing an opportunity to really develop into that market, and the drivers in that are all the things that Dar presented. There's a push from all the Class A product that we have been a part of now to these first ring suburbs that we see the growth and the opportunity throughout. And so what we're calling our middle market target or middle market product is that renter by necessity, where we're developing either a your traditional 3-story garden style, 3 or 4-story garden style walk up, or in the case of a property that we're joint venturing on in Salt Lake, this is a podium style, but it's a different type than we've done in the past. It's much more geared to a very specific price point, very specific renter, a limited amount of amenities, and different finish quality. So this was brought to us through Michael Berman, and we are now doing a joint venture that hopefully leads to other deals in that market, which is a market that you saw in all these presentations. So this is really a number one focus for us right now, is to to break into to solve the Rubik's Cube of cost versus rent at a very strong fundamental price point.
So just a little follow-up, to point out what Kevin, I feel like I'm Charlie from Charlie's Angels, in the background every time. But one of the points Kevin pointed out is, go back in time, we were buying this workforce, B-class housing, the renter by necessity, you'll keep hearing, blue collar. I would say today, or excuse me, back then, what we were building was renter by choice. If it was downtown Denver, Kent Place here, and it was $10,000 a month for a penthouse, I mean, trust me, that is not a renter by necessity. Today, you look at downtown Denver, and these are still renters by choice, but these younger people that are living here at some point as they form families they start going out to the suburbs. And the housing epidemic in the US right now really is just to provide basic housing. So what I call gray collar, not white, not blue, but kind of that middle market, plus that blue collar, and you're going to hear the gray and blue collar discussions. That's really where we see the opportunity, not building high-end nice product. And I think so many people are still focused on this high-end nice product because they believe they can get $3 rents going to $3.50 to $4. And at some point, people are going to tap out and just say, I can't afford it. And again, the demand is not for that high-end product.
And so as both developers and acquirers, how do you think about the buy versus build decision? I mean, a couple of our markets, Minneapolis and Denver, we've done both. So how do you think about that, on a go-forward basis? I don't know, Kevin or Darren or Rich?
Yeah, I guess I would say they're not mutually exclusive, especially as we're focused together in these different product types. Those markets are all growth markets, and I think what we've heard is we're definitely targeted on the growth markets that have seen a real run-up in supply of the Class A and are now spilling out into these first-ring suburbs that are driving demand still with a significant supply. The difference is these are markets traditionally where we couldn't buy into, and so we're now we're heavily competing at a 5 cap. We can probably build to a 6 cap and have a faster growth in rent and also see a better exit cap compression, so that we're seeing that value creation that I think is still fundamental in development. And I don't know if
I think you hit it. I think where can we create value and how do we unlock that value? We sold a lot of our developments historically. When you're getting 3-4 times your money in a couple of years, it's hard not to hit the sell button. As one of my favorite father-in-laws said to me, when the ducks quack, feed them. And so they've been quacking, and so we've been feeding them. And today we feel like, as Kevin said, it's not mutually exclusive. It's both and. If we can, build and it makes sense to create value and put a supplement or a permanent supplemental loan like we just did on Tallow in Minneapolis for the folks that are involved in that, like we'll do at the local in Tempe, those are the types of things we like. And again, more than ever, long-term cash flow. We may have to build to get that cash flow. We may be able to buy. But today is not the time to lever up, meaning to take risk in debt. So we'll use even less debt than we've ever used and take more risk once the property is stabilized and been completed.
We had an investor question asking, what markets have you identified that you feel may not be able to make their projected returns over the next 3 to 5 years? Are there markets that you would look at exiting, or is it asset specific? How do you think about that from a disposition strategy as a whole?
I mean, I think it's asset specific at first. Just, obviously, when we look at it, when we have an acquisition and an operating asset, they each of them have a business plan. So I would say first it's definitely asset specific. From a market standpoint, I would say that, to the capital point that we've talked about a lot, is that when there is so much capital in certain of these markets, we will obviously take a look at those. Semi-annually, we try to get either a broker opinion of value or do an internal calculation to see where we're trading at versus where we purchased. And so we do have those conversations internally, but I don't think I could specifically state that there is a certain market that we're looking to exit right now. I'd say, again, semi-annually, we're going through this process with brokers in the market to try to determine where could there be an exit opportunity, but I don't see any specific market today that we would say we're out of.
I think maybe the bigger question is, where do we see risks? I don't know, for those of you that are in Denver, our property taxes just went up 37%. Hotel I was involved in Cherry Creek just went up 76%. I was in London 3 weeks ago with our insurance renewal. It'll, I promise you, be up 50 to 75%. So I think as we start looking at these markets, again, Andrew, I think you mentioned earlier, it was a basis play. You know, there's a time and place to buy in Louisville, Kentucky, and there might be another time and place to buy in Louisville. Today, I don't see that, because when you start thinking about your income and your expenses, if it's, let's say, 60% is income and 40 is expenses, you know, as those insurance costs, as those real estate taxes keep creeping up and you've got lower growth markets, at some point, there's going to be an inversion, and we want to get out ahead of that and play offense now. Even if it means a lower return, we're going in, taking it, offering a 1031 to go into higher growth market. I'd rather be proactive than reactive, and that to me is one of the biggest risks just moving forward in real estate. Our taxes, well, just the whole expense load.
We've all seen, you know, the Google campus and the great return had there. How do you deal with adversity? And, you know, can you touch on a couple deals that?
Oh boy. For those of you that are involved, geez, where do I start? You know, when I was playing football at CU, my coach gave, or actually our strength coach, he, you know, on the front of the shirt it said prosperity, you know, when times are easy, and on the back it said adversity, when the real fight begins. And Park DIA, it's been almost 6.5 years, and everything that could have gone wrong, I mean everything, from our partner that passed away, to paving 55 acres and having a freeze, to our operator and his partner, I mean, I could go on and on. And so it's one of those, as we called, a troubled asset. This was like a really troubled asset. I had to get the paddles out a few times to keep the patient alive, but we threw everything we could at it. We hired an advisory board just for Park DA. A few of you in this room were on our advisory board. Jimmy, thank you very much. Colano. And we turned it around. And let me tell you how much time a property that doesn't perform takes out of an entire organization. Teresa Hansen, the marketing group, you know, knock on wood. So one of the things that I like to talk about is not the Facebook life. I tell my kids, and no offense to Facebook, but kids I've never seen on Facebook, you know, somebody posts, hey, I had a bad day, I'd love to, you know, go get a drink or have a cup of coffee. It's, hey, I'm on a great vacation and there's no problems, and on and on. So I like talking about who we are for them as a partner. Never have done a capital call, never have lost anybody's money. I personally lent the partnership over $10 million over the last 5 years. That's a lot of money. It's more money than I thought, you know, I'd ever even have. Fortunately, I was able to do that. So I like talking about the deals that don't work out. We're under contract. The seller went non-refundable today with $1 million. It's set to close here end of August now. We gave them a little bit more time. It'll be a 1.8 times your money, you know, 14% roughly return. And so we turned lemons into lemonade. And I knew it was not if, it was when. And so I put my money where my mouth is. I'll get my loan paid back. Everybody will get their original equity back. And, you know, we learned a lot. And, you know, as I tell folks here, my kids, I learn more from my mistakes than I do the successes. So that was one. We had another one for folks that were in our epic Castle Rock. We have one of our partners, David Vitale in town. They were providing 60% of the equity. Our friends and family here were providing 4%. We had closed on the land. In October, as you heard Dar say, the yield curve inverted. I wasn't, my spidey senses were going off and I didn't feel good. And we sent everybody their money back. We had building permits in hand. We had construction loan ready to go. We had all the money. We had signed subscription docs. And I would rather turn my $5 million problem into my problem and not a $70 million problem for everybody. So again, maybe it's from my lending days, but I'm a risk first. It may not be a home run, but we're looking for singles and doubles. And again, that's the type of partner you get in Forum. So I don't always like talking about the great returns, but really talking about vulnerability, and vulnerability creates trust. So hopefully, as Mike Kennedy said, you know, once you send my money back, I knew you were my partner forever. So I appreciate that, and hope you guys do too.
And I guess to follow on that, you know, what makes a good partner to you? What are some things that you value that are kind of non-negotiable that you really value in your partnerships with investors, with, you know, lenders, with brokers?
Sure. You know, again, when times get tough, you know, partnership is not a one-way street. I've had, some people that think it's a one-way street, and that to me is not a partnership. And to me, this is not a race, it's a relationship. It's really easy to go find an institutional partner with the track record that we've had, buying apartments since '03, but I really value making a difference in each and everybody's life in this room and those that have partnered with us. And it doesn't always work. When we're out raising money, I don't mean to sound arrogant, but I'm interviewing people as much as they're interviewing us. We're at that point where are they going to be and understand when things don't work out and we may not have the return that we thought? And, it's always easy to high five everybody when times are tough, but, it's like Nick Saban said, hey, don't look at the clock. Let's look at the process and make sure we keep our head down. And, we did that with Park DA and some of these others. And to me, full circle, a partner is somebody that's with you in the good and the bad.
You have a lot of sayings that most people in this room have heard. One of them is you like to skate where the puck is going. So why don't we talk about some of the new opportunities that we see, coming for Forum over the next few years?
Sure. I'll do high level and let the gals up here dig in. Again, as you heard from Dar, you'll hear from us. There's a housing crisis in America. There's also a ton of capital chasing the same deals. We see affordable housing with a capital A. When I mean that, I mean like tax credit affordable housing. We also see an opportunity to build like a merchant build to own. So we've come up with a real basic product. It's a Class B product. It's 24 unit product in one building. It's a small 1 bedroom and a large 1 bedroom, a small 2 bedroom and a large 2 bedroom. And we stack them. And if we take that 24 unit building, we do it 10 times, we've got 240 units. If I were to tell you in 10 years, we as a group own 10,000 apartment units in and around Denver, Colorado, and the suburbs, I can promise you we will all make a ton of money and we'll own them hopefully forever and cash flow the heck out of them. So the last part of it would be going through the entire capital stack. And if we can get equity-like returns, mom equity, with debt-type risk, so lower risk with higher returns, and be around the hoop, that's what I've had in the works for almost 3.5 years with Forum Capital Advisors, is we don't have to go do anything right now. I do see opportunity, and so these are three of the things that have been in the works, and we'll talk further in our breakout sessions as well.
Andrew, why don't you give some high-level points on the affordable housing partnership that we're working on?
Sure. So we've partnered with Ledick Realty Company. They're headquartered in Memphis. They are the 4th largest affordable owner-operator in the United States. And to Darren's point, when we talk about affordable with a big A, these are properties in which tenants' rent is to some degree paid by the U.S. government via a HAP contract, old Section 8 housing vouchers, and so and like Dar said, I'm not going to become political, but the income inequality in America isn't going anywhere. It's probably getting worse, and so we think that there is an opportunity on the affordable side, and so. Partnering with Ledick, what we've built is a platform whereby we're going to be purchasing assets when they're out of the preservation period. And the preservation period is the time in which the tax credit equity, I'm not going to get into this because everyone looks a little tired, so I'm going to go real high level. If anybody wants to talk to me afterwards, I'm happy to go through affordable. Big picture is it's about a 4 to 5 year targeted hold, and we're targeting a 12% IRR, low to mid-teens cash on cash. But I do think that as we've talked about market rate deals having a lot of competition, there's still competition on the affordable side, but the complexity behind these is a lot greater. There's the need for government regulations. You have to do yearly walks of the units. You got to make sure that you're really in compliance with everything. Otherwise, you can get your HAP contract pulled. So I think the fact that you have to roll up your sleeves and put in a little bit of elbow grease on these deals is what deters a lot of folks. But that's where I think in today's environment, that's what you need to do to make money. So that's where we're focused, and I think over the next 2 to 4 months, you'll see something from us on that.
I don't know if Jay Jester's here, but we've certainly had fun learning about the complexities involved with this transaction.
Yes, we have.
What? Yeah.
Yes, we have.
So the question, to abbreviate, was why the heck are we going to sell if we can't find anything to 1031 into? I think there's bigger risk in not selling in some of these assets long term. The degradation of, as we call it, the rent roll or income statement is greater than the tax consequence, I don't want to pay tax either, trust me. One of the things we'll look at, and we'll get into, we'll address later, is what do 1031 opportunities look like? I personally would rather take a lower return in a higher growth market with less leverage from a risk standpoint than leverage up and go into a tertiary market where all the people, as I say, the US, all the lemmings have gone into our playground and we're getting out, and we'll come back in once they make mistakes. But I'd rather go to a Tampa and clip, I know people are gonna, I may even fall over if I say 6% return, but a 6% return. I'd rather do that. You know, if we can double our money, get out and take a 6% return in a Tampa or Orlando where you're seeing higher growth, then trade that into, you know, I don't know, Winnemucca, Nevada, you know, because it's a 10% yield. That 10% may be today, but it's not going to be for a long time.
But that is your intention.
That's our intention. Right, correct.
In a market with higher growth and better long-term potential. I think
know,
that's
and-
the big shift.
Well, and the other thing, you know, while across the board, these metros that are higher growth are more competitive and have lower yields, there's variability depending on where you are. And you know, for example, Denver Metro, the Front Range is economically interconnected, right? So from Fort Collins all the way down to Castle Rock, there is commuting patterns and economic connections that if you're downtown Central Business District, you have one yield, but if you are up near Loveland, it's slightly different. So, I mean, I think that there's a product question and there's a submarket question that we always look at with every investment alternative.
You know, a lot of very smart experts out there are saying that, you know, Sam Zell and others, that we're not as highly levered as we were in 2008. So, you know, they're seeing a lot of LTVs in the 65 to 70%. So what are the thoughts on these potential defaults and the likelihood of potential opportunities in those distressed investments? Jason, you probably see that a lot. You can touch on that?
Yeah, I mean, look, I think that's correct. I saw Sam speak actually in Chicago, and we're nowhere near as levered today as we were 06, 07, 08. So I would imagine that whatever distress we're going to see is not going to be a systemic type of event. It's going to be very market specific, product type specific. So I'm not expecting a whole host of opportunities like we had, but I mean at the same time there are individual sponsors that are trying to juice leverage a little bit more. Maybe they're buying at a 5 cap instead of a 6 cap, and so based on the leverage that they need to generate their low double-digit returns for their LPs, then maybe they're juicing that leverage a little bit. And so it's those opportunities on a one-off basis that you might see. Having said that, a lot of the institutional type financings that I'm seeing, the nice part about where I sit is, I'll see the financing off of, a Blackstone buying a company like Gramercy, an industrial REIT, or, the Grand Wailea Hotel in Hawaii.
What do we see as the biggest threat to real estate today? Anybody can answer that. You may all have different opinions on that. What sets this apple cart upside down?
Again, I always say there are two reasons you get in trouble in real estate. You're over leveraged or your debt comes due. Those two still remain, and I think the third again is operating expenses. I think operating expenses, from insurance to these states that have no state income tax are going to get it somewhere, and the municipalities now are playing a little game. Most of you, when you can appeal your real estate taxes, but when the municipality changes the mill levy that they're calculating your real estate tax on, there's no appealing the mill levy. So they're getting smart too. Not all of them, but a few of them. We just saw that on a property we have here in Denver, and there's no appealing. So I think it's the same too, and I think it's also operating expenses.
Yeah, I think there's no secret on development that cost is probably a number one impediment to getting a deal to pencil, and so we feel that we've had slower years in the past 2 years as a result. Darren mentioned Epic, Castle Rock, and a few others that we just didn't feel like we had the right basis. So cost basis is going to be critical for us to underwrite very diligently, sensitize to a negative event, and make sure that we're very comfortable in the submarkets that we're in, and we won't move forward. We're not going to challenge and press forward on a bad deal.
I think one last thing, and for those of you that have heard this or my annual newsletter for 15 years. I always say at the end of the January, I said, when I got in the business in 2001, the 10-year Treasury was at 3%. Well, it's 2019, it's at 2.4%. And so when you borrow floating rate, let's say a LIBOR is at 2.5%, and if you're borrowing at LIBOR plus 300 on a construction loan, you're at 5.5%. You've got 2.5, 3 years to build it, stabilize it. I mean, we just locked in a loan on Tallow. It was a 11-year.
11-year IO,
Yeah.
451.
For what was the
451.
451. So I can get a 11-year loan at 4.5% or a floating rate, a lot of risk at 5.5. So I do see developers that take that floating rate risk. I still don't believe interest rates are going up. I'm sorry, I don't know how we ever get out of this environment. But if that does happen, that's where I think there will be market dislocation as well.
The only other thing I would say, we've talked a lot about debt, but on the equity side, not having patient LP equity right now, folks are going to have to be getting out of some deals, right? So if you're in a 10-year fund and your LP equity says we got to get to our minimum IRR hurdle and it's time to sell, it's time to sell. And so I think that it's not going to upset the apple wagon, like you said, but I think it will give us opportunity because we have patient LP equity. We have the ability to come in and do that. And so I think that with those funds that have the proverbial gun to their head, we will come in, and I do see that as something over the next few years.
I think it's also being smart. Like the Tallow debt, it was 11 years of IO, but you're at 65% LTV. You're not coming in at 80% and doing that. I mean, we like amortization. We like having a lower LTV, so I think that that's really important. Any other questions? I guess, a final question would be, if I have $1 today, I've got all these opportunities, how do you, talk to investors and say, this is where, I would guide your money?
So not everybody likes a red dress. Those of you, that's one of my sayings. So I think it just depends on who you are and what it is in your own personal bucket that you're looking for. You might want a red dress or an orange dress, or you might like development, you might like debt. You may not like any of it right now. And so the nice thing about Forum is we're not, again, an allocator. We have an option, or we give optionality in the entire real estate multifamily capital stack. If you like debt, if you like development, if you like acquisitions, or affordable housing, it's a poo-poo platter. Take your choice.
Should just leave it at that.
All right.
It's a poo-poo platter.
If we don't have any other questions, we will take a break until about 3:15. Nobody? All right. We'll leave it with
Thank you.
that.